Welcome to today's deep dive on passive investing versus trying to beat the market. We'll explore why broad market index funds have won for most investors, the temptation of tech-heavy bets, and how to structure a practical plan if you have consistent capital to invest. Along the way, we'll build an action plan with safeguards, include diagrams to make things visual, and test your knowledge with a short quiz. Let's begin by outlining what we'll cover. First, we will examine why passive investing frequently outperforms active strategies for most people. Next, we will discuss the allure of technology stocks and the risk of concentration. Then, we will show how index funds already include significant exposure to tech while keeping diversification. After that, we will build a practical action plan for someone investing $2,000 per month over a long time horizon. Subsequently, we will cover fees, frictions, and guardrails. Finally, we will quiz you to reinforce the key ideas. Before we proceed, please note this is educational content and not specific financial advice. Everyone's situation is different, and you should conduct your own research and consult a qualified, fiduciary financial professional where appropriate. Now let us consider why passive investing frequently wins. Broad market index funds such as the S&P 500 or total world funds deliver instant diversification across sectors and companies. Fees remain minimal compared to actively managed funds or frequent trading. Over long horizons, the majority of active managers underperform their benchmarks after costs and taxes. Therefore, for the average investor with decades ahead, a simple, automated index approach emphasizes consistent compounding while minimizing errors. To understand why indexing works, notice how an index like the S&P 500 is diversified across many sectors. Although technology is a large component, you still hold healthcare, financials, industrials, and more. Low fees reduce drag and improve long-term compounding. You automatically gain exposure to winners as indexes reconstitute over time, without having to guess in advance. Consequently, staying invested consistently often beats attempts to time entries and exits. The sector weights shown are illustrative and change over time, which reinforces the point that indexes evolve with the economy. Comparing passive and active approaches, passive investing offers low costs, broad diversification, minimal research, and alignment with long-term compounding. In contrast, active approaches may promise higher returns, but typically introduce concentration risk, higher fees, tax inefficiencies, and more time commitment. Moreover, behavioral pitfalls such as performance chasing or panic selling can erode results. Therefore, for most investors, the passive route serves as a resilient default. Many investors are drawn to technology's historical outperformance and clear role in innovation. However, concentrating exclusively in a single sector elevates volatility and increases the risk of substantial drawdowns. Even great sectors can become overpriced, as enthusiasm outpaces fundamentals. Because narratives can shift quickly, concentrated bets may turn into costly mistakes. Therefore, while tech may be compelling, relying solely on one sector can jeopardize long-term goals. Importantly, broad indexes already hold meaningful exposure to technology because of market capitalization weighting. As leaders grow, their weights increase within the index. Consequently, you participate in technological progress while maintaining diversification across the broader economy. The timeline shown is illustrative and underscores how tech's index weight fluctuates with cycles. This approach lets you benefit from innovation without taking on the full risk of a single sector portfolio. This flowchart begins by asking whether you have a long time horizon and consistent income. If the answer is yes, the default recommendation is a broad index such as the S&P 500 or total market. If the answer is no, first solidify your safety buffer and align investments with shorter-term goals and required liquidity. From the default index node, the chart asks whether you experience fear of missing out or a desire to experiment. If so, route a small portion 5 to 10% into a play account treated as potentially lost. If not, maintain a 100% index allocation. A guardrail reminds you to rebalance annually and keep the play portion under 10%. Additional risk checks emphasize reducing the play slice if stress or drawdowns become problematic, and avoiding leverage or concentrated positions. Here is a concrete plan for $2,000 per month. First, automate contributions to a broad index fund on payday to remove decision friction. Next, place 90 to 95% into the core index, and allocate 5 to 10% to an optional play account. Treat the play money as expendable, avoiding leverage and minimizing concentration. Then, rebalance annually to restore your target allocation. Additionally, take advantage of tax-advantaged accounts where applicable, and maintain an emergency fund to avoid forced selling. As your income grows, increase contributions to accelerate compounding. This table shows 3 simple configurations for a $2,000 monthly plan. The conservative plan allocates $1,900 to the index and $100 to a play account. The balanced plan places $1,800 into the index and $200 into the play sleeve. Finally, the all-core plan directs the entire contribution to the index, which is the simplest approach for those who prefer maximum diversification and minimal complexity. Moving forward, it is essential to control frictions. Low expense ratios provide a persistent edge as savings compound over long periods. By contrast, high turnover strategies may trigger taxes and increase transaction costs or slippage. Index strategies inherently reduce trading frequency and behavioral mistakes. Therefore, a simple plan that is automated, consistent, and periodically rebalanced can be both efficient and durable. Here is a concise recap. Over long horizons, low-cost indexing tends to outperform. Diversify across sectors and geographies, automate your contributions and rebalancing, and minimize fees, taxes, and behavioral mistakes. As a helpful rule of thumb, time in the market tends to beat timing the market. If you need to experiment, keep a small and controlled play account at 5 to 10% of contributions. Question: for a long-horizon investor contributing $2,000 per month, what is the most rational default structure? Option A, 90 to 95% in a broad index with 5 to 10% in a small play account. Option B, 50% in a tech-only fund and 50% in cash. Option C, day trade AI stocks with leverage. Option D, hold all funds in cash to avoid volatility. You may pause the video now to consider your answer. We will discuss the answer in the next section. The correct answer is A. This approach preserves the benefits of diversification and low costs while allowing a modest, controlled outlet for experimentation. It balances discipline with flexibility and maintains alignment with long-term compounding. Question: what is the primary risk of moving entirely into a tech-only portfolio instead of a broad index? Option A, concentration risk and higher volatility. Option B, lower fees than indexing. Option C, guaranteed higher returns. Option D, better sleep and less stress. You may pause the video now to think about your answer. We will reveal the answer in the next section. The correct answer is A. Concentrating in one sector increases volatility and downside risk. When sentiment reverses or valuations contract, drawdowns can be severe. Diversification within a broad index helps mitigate this exposure. These are the core insights. Indexing provides a robust default through simplicity, low costs, and diversification. Broad indexes already hold significant exposure to technology. If you must experiment, keep the play allocation small and governed by strict guardrails. Automate and rebalance while focusing on increasing your income to power compounding. Above all, recognize that consistently beating the market is rare, even among professionals. In summary, choose a broad index approach as your default and remain consistent. If you feel compelled to experiment, keep the play account small and capped, minimize costs, automate contributions, and rebalance annually. Finally, give compounding time to do the heavy lifting. Patience and discipline are the real edges. Thanks for watching. If this was useful, please like the video, share it with someone who needs a simple plan, and subscribe for more practical investing content. In the comments, tell us whether you identify more with a passive approach, a small play sleeve, or a mix of both, and why. Your experiences and questions help the whole community learn.